In September 1992, one man made $1 billion in a single day. He didn't build a company. He didn't invent anything. He didn't get lucky. He looked at one of the most powerful financial institutions in the world, decided it was wrong, and bet everything against it. His name was George Soros, and the institution he was betting against was the British government itself. This is the story of Black Wednesday, the day a hedge fund manager broke the Bank of England, humiliated an entire nation, and walked away with more money than most countries make in a year. To understand what happened in 1992, you need to understand what Europe was trying to become. The Berlin Wall had fallen in 1989. The Soviet Union was collapsing. European nations, exhausted by decades of division, were moving towards something they had never attempted before, a unified economic bloc. The centerpiece of this project was the exchange rate mechanism, or ERM. Introduced in 1979, the ERM was a system that locked European currencies together within fixed trading bands. The idea was simple. If currencies stayed stable relative to each other, trade would flow more freely, inflation would stay low, and Europe could eventually move toward a single currency. Britain had resisted joining for years. Margaret Thatcher, never enthusiastic about surrendering economic sovereignty to Brussels, had kept the pound out. But in October 1990, under pressure from her own cabinet, Britain entered the ERM. The pound was pegged to the German Deutsche Mark at a rate of 2.95 marks to the pound, with a permitted fluctuation of just 6% in either direction. It seemed like a moment of European solidarity. It would become one of Britain's most expensive policy mistakes. The moment Britain entered the ERM, economists started noticing something uncomfortable. The rate at which Britain had joined, 2.95 marks to the pound, was too high. Here's why that mattered. When a currency is overvalued, exports become expensive. Foreign buyers pay more for your goods. Factories slow down. Unemployment rises. To keep an overvalued currency stable inside a fixed exchange rate system, a country has to keep interest rates high enough to make holding that currency attractive to investors. Britain was already struggling. The early 1990s had brought a recession, unemployment was climbing, businesses were failing. The last thing a weakening economy needed was high interest rates making borrowing more expensive for companies and homeowners alike. But the ERM left Britain with almost no room to maneuver. Cutting interest rates would weaken the pound. A weakened pound would fall outside the ERM bands. Falling outside the bands would mean exiting the system, a humiliation the British government had staked its credibility on avoiding. So Britain held. Interest rates stayed high. The economy continued to deteriorate, and the gap between where the pound was and where it should have been kept widening. For most people, this was a policy problem, a technical headache for Treasury officials and central bankers. For George Soros, it was an opportunity. George Soros was not a conventional figure in finance. Born in Budapest in 1930, he had survived Nazi occupation as a teenager by adopting a false identity. He escaped communist Hungary after the war, made his way to England, studied philosophy at the London School of Economics, and eventually emigrated to the United States. He came to finance, not through inherited wealth or elite connections, but through an obsession with a single question: how markets form beliefs, and how those beliefs become self-fulfilling. His philosophy, which he called reflexivity, argued that markets are not efficient. Investors don't just respond to reality, they help create it. When enough people believe a currency is weak, they sell it. When they sell it, it weakens. The belief and the outcome feed each other in a loop that conventional economics struggled to account for. By 1992, Soros was running the Quantum Fund, one of the most successful hedge funds in history. His track record was extraordinary. His methods were unconventional. And his appetite for large, concentrated bets was unlike almost anyone else in the industry. He had been watching Britain's situation for months. What he saw was a government trapped, publicly committed to a position that the underlying economics made increasingly untenable. The pound was overvalued. Britain couldn't raise rates without devastating its own economy. It couldn't devalue without admitting the ERM entry had been a mistake. And it couldn't hold the line forever with foreign currency reserves that were finite. It was, in Soros's assessment, a one-way bet. If he was wrong, he would lose the cost of maintaining a short position, manageable. If he was right, the potential gain was enormous. A currency devaluation of the magnitude he expected would mean billions. He began building his position. Shorting a currency is not complicated in principle. You borrow the currency you expect to fall. Sell it immediately for another currency. Wait for the fall. Buy the original currency back at the lower price. Return what you borrowed, and keep the difference. In practice, doing this at the scale Soros was contemplating was something else entirely. Through late 1991 and into 1992, the Quantum Fund quietly accumulated a short position against the pound. By September 1992, Soros had borrowed and sold approximately $10 billion worth of British pounds. $10 billion. For context, Britain's entire foreign currency reserves at the time were somewhere between $40 and $44 billion, and not all of those reserves could be deployed to defend the pound. The Bank of England would have to fight back with one hand partially tied behind its back. Soros was not alone. Word had spread through the hedge fund community. Stanley Druckenmiller, who managed day-to-day operations at the Quantum Fund, was among those who believed the position was sound. Other funds were building similar bets. The collective pressure that was about to hit the pound was larger than any single institution had anticipated. The stage was set. The only question was when. The morning of September 16, 1992 began with the British government still publicly committed to defending the pound. Markets opened. Selling pressure on sterling was immediate and severe. The pound began dropping toward the lower limit of its ERM band. The Bank of England moved to defend it. The mechanism was straightforward. Buy pounds, sell foreign currency reserves, push the price back up. The bank began purchasing sterling in enormous quantities. Billions of pounds worth of reserves were deployed in the first hours of trading. It wasn't enough. The selling pressure from hedge funds and currency speculators was relentless. For every pound the Bank of England bought, the market was selling more. By mid-morning, the British government escalated. At 11 a.m., interest rates were raised from 10% to 12%. The announcement was dramatic. A 2 percentage point increase in a single move was almost without precedent in modern British monetary policy. The signal was unambiguous. The government was willing to cause significant economic pain to defend the pound's position in the ERM. Markets barely reacted. The pound continued to fall. 2 hours later, the government made an even more desperate announcement. Interest rates would be raised again, from 12% to 15%, a 5 percentage point increase in a single day. Mortgage holders across Britain were facing the prospect of their monthly payments becoming catastrophically expensive, almost in real time. Still the pound fell. The math had become brutal. The Bank of England was burning through foreign currency reserves at a rate that could not be sustained. Defending the pound was not just economically damaging, it was arithmetically impossible. There was a finite amount of money available to buy pounds. There was no finite limit to the amount the market could sell. Inside the Treasury and the Bank of England, the reality was setting in. This could not be won. Norman Lamont, the Chancellor of the Exchequer, had been on the phone through much of the day, with European counterparts, with the Prime Minister, with the Governor of the Bank of England. The options were narrowing by the hour. John Major, the Prime Minister, had staked enormous political capital on ERM membership. It had been a cornerstone of government economic strategy. Exiting would be an admission that the policy had been wrong from the beginning. But the alternative, continuing to hemorrhage reserves with no prospect of stemming the tide, was no longer viable. At 7:30 p.m. on September 16, 1992, Norman Lamont stepped outside the Treasury to make an announcement. Britain was suspending its membership of the exchange rate mechanism. The pound would no longer be defended. It immediately fell more than 15% against the Deutsche Mark. George Soros woke up the next morning to the final accounting of what had occurred. His short position against the pound had returned approximately $1.5 billion in profit. In a single day, some estimates placed the figure even higher. The Quantum Fund's total gain from the trade, including positions in related markets, was later reported at close to $2 billion. It remains one of the most profitable single trades in the history of financial markets. When asked about the trade in subsequent interviews, Soros was characteristically direct. He had identified a flaw in a system. He had acted on his analysis. The fact that his profit came at the cost of British taxpayers and homeowners was not, in his view, a moral failing. It was the nature of how markets operate. This answer did not satisfy everyone. For Britain, the consequences were significant and lasting. The immediate cost of defending the pound, the foreign currency reserves spent buying sterling before the suspension, was estimated at between £3 billion and £6 billion. That was taxpayer money, spent and lost in a single afternoon. Interest rates, which had been raised to 15% during the crisis, were cut back rapidly once the ERM constraint was removed. The pound found a new, lower trading level. And something unexpected happened. The British economy began to recover.
Freed from the obligation to maintain an artificially high exchange rate, exports became more competitive. Interest rate cuts made borrowing cheaper. The recession began to ease. By the mid-1990s, Britain was in the early stages of sustained economic growth. There is a deeply uncomfortable irony embedded in this. The event that was politically catastrophic for the Conservative government, and which ended any realistic prospect of John Major winning the next election, may have been economically beneficial in the medium term. Ejection from the ERM forced the very devaluation that many economists had argued was necessary all along. But the political damage was done. A government that had built its identity around economic competence had been visibly defeated by a hedge fund manager. The question of who was actually in control, elected governments or financial markets, was posed in the starkest possible terms. Major's government never recovered in the polls. Labour won the 1997 election in a landslide.
The story of Black Wednesday is told as a story about George Soros, about genius, about nerve, about the willingness to make an enormous bet against conventional wisdom. But there is another way to read it. Soros did not create the conditions that made the pound vulnerable. Those conditions were created by policymakers who entered a fixed exchange rate system at the wrong rate, refused to acknowledge the error publicly, and then held on long after the economics made the position untenable. What Soros did was identify the gap between official position and underlying reality, and place money on the side of reality. This is, in a sense, what financial markets are supposed to do. They are supposed to price things at what they are actually worth, not at what governments would prefer them to be worth. When a gap opens between those two things, capital flows toward closing it. The larger the gap, the more violent the correction. Britain's gap in 1992 was enormous. Soros did not break the Bank of England. The Bank of England's position was already broken. He was simply the first to bet large enough, and publicly enough, that the truth could no longer be ignored. The $1 billion was not the point. The point was that markets, when they decide something is mispriced, are more powerful than the institutions insisting otherwise. That lesson has been learned and forgotten more times than anyone would care to count. It will be learned again. George Soros went on to become one of the most controversial figures in global finance, celebrated by some as a visionary, condemned by others as a destabilizing force. The Black Wednesday trade defined his public identity in ways that still shape how he is perceived today. The exchange rate mechanism continued without Britain. The European single currency, the euro, was eventually launched in 1999. Britain never joined. And somewhere in the records of the Quantum Fund, there is a position that once stood at $10 billion short on the British pound, the trade that proved that even the most powerful governments in the world have limits. Soros found the limit. He just charged admission to see it.